Stop everything you're doing right now. Close your other tabs. Put down your phone. What I'm about to tell you is the most significant development in the history of precious metals investing. Silver just became the second largest asset on planet Earth. Let me say that again so it sinks in. Silver, the metal that Wall Street has mocked for decades, the metal that banks have suppressed and manipulated, the metal that your financial advisor told you was a relic of the past, just passed Nvidia to claim the number 2 spot in global market capitalization. Gold sits at number 1 with 31.1 trillion. 31 trillion. That is not a typo. That is the market screaming at the top of its lungs that the old financial order is dying. And silver is right behind it, battling with the most hyped technology company on Earth for second place. This is not a normal market move. This is a regime change. This is the moment that historians will point to and say that is when everything changed. That is when precious metals reclaimed their throne. That is when the world finally woke up to the reality that paper currency is a confidence game and confidence is evaporating. In this emergency broadcast, we are going to dissect this historic moment from every angle. We are going to explain why silver passing Nvidia is not just symbolic, but structural. We are going to expose the CME Group, his desperate attempt to stop this rally with a 30% margin hike, their fifth intervention in just 9 days. We are going to analyze China's export restrictions that have created a supply shock, the likes of which we have never seen. We are going to look at the mining stocks that are printing money while the broader market trembles. And we're going to map out the path to $100 silver that now looks not just possible, but inevitable. The establishment is throwing everything they have at this rally. Margin hikes, media manipulation, regulatory intervention, and silver still hit $82.58. Gold still hit $4,500. They are losing control, and you are watching it happen in real time. Let us start with the market cap rankings, because these numbers tell a story that no headline can capture. According to data from companies' market cap, gold now holds the top spot globally with approximately $31.1 trillion in market capitalization. Think about what that means. Gold is now more valuable than any company on Earth, more valuable than Apple, more valuable than Microsoft, more valuable than Saudi Aramco. The largest publicly traded entities that humanity has ever created are now smaller than a metal that has been money for 5,000 years. This is the market voting. This is trillions of dollars flowing out of paper assets and into hard money. This is the smart money front running what they know is coming, a fundamental repricing of everything we thought we knew about value. Silver is right behind gold, briefly overtaking Nvidia for... But let me be clear about what is happening here. Silver and Nvidia are now trading places on a daily basis. The second largest asset on Earth is alternating between a semiconductor company, riding the artificial intelligence wave, and a metal that conducts electricity better than almost anything on the periodic table. This is not a coincidence. The market is telling us that the future belongs to both. Artificial intelligence needs silver to function. Solar panels need silver to generate power. Electric vehicles need silver to move. The digital future that Nvidia is building runs on silver, and the market is finally pricing that in. Now let us talk about what happened on January 6th and 7th, because these 48 hours will be studied in financial textbooks for generations. The silver market witnessed a historic and highly volatile trading session as spot prices breached the $80 mark for the first time in history. The white metal surged over 6% in the New York session on Tuesday, driven by what analysts are calling a perfect storm of geopolitical upheaval and a crippling supply shock from China. But the fireworks did not stop when New York closed. The overnight session delivered what traders are calling a whipsaw rally that briefly touched $82.58 per ounce. On India's multi-commodity exchange, prices hit a historic all-time high of 259,692 rupees per kilogram. These are numbers that Silver Bear said were impossible. These are numbers that the mainstream financial media told you would never happen. These are numbers that prove everything we have been telling you about the physical shortage and the paper manipulation. The market broke through their ceiling. And now there is nothing above us but blue sky. But here's where the story gets interesting. As the New York pre-market opened on the morning of January 7th, the rally faced a sudden liquidity vacuum. Prices retreated to $79.15 by 4:30 in the morning Eastern Time. The financial media immediately declared the rally over. They called it profit-taking. They called it a bubble bursting. They said silver had gotten ahead of itself. But what they did not tell you is what caused that liquidity vacuum. What they did not tell you is that the CME Group intervened with one of the most aggressive regulatory actions in the history of commodity markets. The CME implemented a massive 30% increase in maintenance margins for silver futures. This raised the requirement to $32,500 per contract. Let me put that in perspective. This was the fifth margin hike in just 9 days. 5 times in 9 days, the exchange has raised the cost of holding a silver position. They are not doing this because the market is healthy. They are doing this because they are terrified. They are terrified that the short squeeze is out of control. They are terrified that the bullion banks who hold massive short positions are facing systemic risk. They are terrified that retail investors and industrial buyers are draining the physical supply and exposing the paper game for what it is. A margin hike is not a market event. It is a weapon. It is the exchange saying, we will make it so expensive to hold this position that you will be forced to sell. It is designed to trigger liquidations. It is designed to force weak hands out of the market. It is designed to protect the banks who are bleeding billions of dollars on their short positions. And here's the beautiful part. It is not working. Despite 5 margin hikes in 9 days, silver still hit $82. Despite the most aggressive regulatory intervention since the 2011 spike, silver still broke through 80. The margin hikes are slowing the rally, but they cannot stop it, because the margin hikes do nothing to address the fundamental problem. The fundamental problem is that there is not enough physical silver to meet demand. You can raise margins to infinity, and it will not create a single new ounce of silver. You can force every speculator out of the futures market, and the industrial buyers will still need metal for their solar panels and their electric vehicles and their artificial intelligence data centers. The CME is fighting a war against physics, and physics always wins. Let us talk about China, because this is the catalyst that changed everything. On January 1st, 2026, China implemented a new restrictive export licensing regime for silver. This effectively strangled the global supply chain for the solar and artificial intelligence industries. Think about the timing. China controls a massive portion of global silver refining. They have been accumulating metal for years while the West was distracted by paper trading. And now, at the exact moment when global demand is exploding, they tightened the valve. This is not an accident. This is economic warfare. This is China recognizing that silver is a strategic asset and acting accordingly. The West has been treating silver like a trading vehicle. China has been treating it like a weapon, and now the weapon is deployed. When China restricts silver exports, every solar panel manufacturer outside of China faces a choice: pay whatever price the market demands or shut down production. When China restricts silver exports, every electric vehicle maker outside of China faces a supply chain crisis. When China restricts silver exports, every data center builder racing to deploy artificial intelligence infrastructure faces delays that could cost them billions. This is not about speculation. This is about industrial survival. The companies that need silver to operate are not price sensitive. They are availability sensitive. They will pay $80. They will pay $100. They will pay $200. Because if they do not get the silver, they do not have a business. Elon Musk himself weighed in on the China restrictions with 2 words that moved markets. This is not good. That is what he posted on X in response to a tweet about Chinese export controls. When the richest man in the world, a man who runs multiple companies that depend on silver, says this is not good, you should pay attention. Musk understands supply chains better than almost anyone alive. He has spent years fighting to secure lithium for Tesla's batteries. He knows what happens when a critical material becomes scarce. He knows that price is not the problem. Availability is the problem, and right now, silver availability is collapsing. The export restrictions are creating a structural deficit that cannot be solved with margin hikes or media manipulation. It can only be solved with higher prices, much higher prices. Now let us examine the short squeeze, because this is where the real pain is happening. As industrial users scrambled to secure physical bullion, paper speculators were caught in a massive squeeze. The bullion banks that have held short positions for years, betting that they could always cap the price with paper contracts, are now facing an existential threat. Every dollar that silver rises costs them millions. The margin calls are relentless. The losses are mounting. And they cannot exit their positions without driving the price even higher. This is the doom loop that we have been predicting for years. The shorts are trapped. If they cover, they push the price higher and trigger more covering. If they do not cover, they face unlimited losses as the price continues to rise. The CME margin hikes are an attempt to bail them out. By forcing retail longs to liquidate, the exchange is providing liquidity for the shorts to exit. But it is not enough. The buying pressure is too strong. The physical shortage is too severe. The institutional and industrial demand is too relentless. For every retail trader who gets margin called out of their position, there is a pension fund, or a solar company, or a central bank ready to step in. Let us look at the winners in this squeeze, because the gains are staggering. First, Majestic Silver Corp, which derives nearly 60% of its revenue from silver, saw its stock surge 9.86% on January 6th, as investors sought direct exposure to the metal as breakout. This is a company that was left for dead a few years ago. This is a company that the market valued as if silver would never rise again. Now it is printing cash flow that rivals technology companies. Pan American Silver rose 4.48%. Silver North Resources, a junior explorer, jumped 16.3% on speculation that its high-grade deposits could become essential as the global supply deficit widens. This is how generational wealth is created. You identify an asset that is fundamentally undervalued. You buy it when no one else wants it. You hold through the volatility and the manipulation and the ridicule. And then one day the market wakes up and reprices everything overnight. That day is here. The miners that were trading at bankruptcy valuations are suddenly worth multiples of their previous prices. And we are just getting started. At $80 silver, these companies are profitable. At $100 silver, they are gushing cash. At $150 silver, they become some of the most valuable enterprises on Earth. Now let us address the losers, because every squeeze has casualties. The primary losers are the institutional short sellers and the industrial consumers who failed to hedge their silver requirements. Imagine you are a solar panel manufacturer who did not lock in your silver supply. Yesterday, your input cost was $70 per ounce. Today, it is $80. Tomorrow, it might be $90. Your profit margins are evaporating in real time. You have two choices: raise prices to your customers or absorb the loss. Either way, you're in pain. The bullion banks are in even worse shape. They have been running a fractional reserve system for decades, selling more paper silver than physical silver exists. They have been confident that they could always settle in cash or roll contracts forward indefinitely. But the current environment is exposing the fraud. When industrial buyers demand physical delivery, when investors stand for delivery instead of rolling, the paper game collapses. The banks have to find actual metal, and the metal is not there. Fresnillo, one of the world's largest primary silver producers, actually saw its shares drop 3% on January 7th, despite the rally in silver prices. Why? Because the broader London commodity sector was pulling back, and concerns over rising operational costs were weighing on the stock. This is the complexity of investing in miners. Even when the commodity price is soaring, individual companies can underperform due to company-specific issues. This is why diversification matters. This is why you need to understand the individual stories, not just the macro thesis. The iShares Silver Trust, ticker SLV, exhibited significant gap behavior during this period. It closed at $73.68 on January 6th, but gapped down to $71.45 in the January 7th pre-market. This illustrates the risks of holding silver-linked ETFs during periods of extreme overnight volatility. When you own SLV, you own a paper claim on silver held in a vault. You do not own the physical metal. During periods of stress, the ETF can trade at significant premiums or discounts to its net asset value. The overnight gap was the market recalibrating after the CME margin hike triggered liquidations in the futures market. If you are holding paper silver, you are exposed to these dislocations. If you are holding physical silver, you are insulated. The coins in your safe do not gap down at 4 in the morning because a regulator in Chicago changed the margin requirements. This is the fundamental difference between owning the asset and owning a claim on the asset. In a crisis, claims can fail. The asset endures. Let us put this moment in historical context because understanding history helps us understand the future. This event marks a significant departure from traditional market correlations. While gold also touched near record highs of $4,500, silver's high beta nature resulted in much larger swings. This reminds veteran traders of the 1980 Hunt brothers' attempt to corner the market in the 2011 price spike. But the current environment is fundamentally different. In 1980, the Hunt brothers were trying to manipulate a market for personal gain. Today, the market is moving because of structural supply-demand imbalances that no one can manipulate away. In 2011, the spike was driven primarily by inflation fears following the financial crisis. Today, the spike is driven by a combination of inflation fears, geopolitical chaos, and genuine physical shortage. The role of green energy and artificial intelligence makes this rally unique in history. Unlike previous spikes driven purely by monetary factors, the 2026 surge is underpinned by a structural deficit. China's export restrictions are colliding with a massive silver demand required for high-efficiency solar panels and AI-optimized data centers. This demand is not discretionary. It is not going away. It is accelerating. Every country on Earth is racing to deploy renewable energy. Every technology company is racing to build AI infrastructure, and all of them need silver to do it. This is the first time in history that silver is rallying because the world literally cannot function without it. The regulatory response from the CME also signals a new era of active market management. By aggressively hiking margins, regulators are attempting to prevent a repeat of the 2022 nickel market collapse on the London Metal Exchange. Remember what happened with nickel? The price spiked so fast that the exchange canceled trades and changed the rules retroactively to protect a single Chinese nickel producer who was caught short. The LME destroyed its credibility in a single day. The CME is trying to avoid the same fate, but their managed volatility approach creates its own problems. By raising margins so aggressively, they are creating a liquidity trap where only the most well-capitalized players can maintain positions. This could lead to a permanent shift in how silver is traded, moving away from speculative paper contracts toward physical delivery and private off-take agreements between miners and technology giants. This would be bullish for physical silver prices. If the paper market becomes too expensive and too risky to trade, capital will flow into physical metal. The disconnect between paper and physical will widen, and the physical price will become the only price that matters. Now, let us talk about safe haven demand, because this is the tidal wave lifting all precious metals. Investor demand for gold and silver has strengthened over the past year as markets grapple with global conflicts, trade disputes, and policy uncertainty. The capture of Venezuelan President Nicolas Maduro sent shockwaves through global markets. The blockade of oil tankers, the actions against the Islamic State in Nigeria, the escalating tensions between China and Japan after Beijing imposed export controls on items with potential military use. All of these events are driving capital into the only assets with no counterparty risk, gold and silver. When you own a treasury bond, you're trusting the U.S. government to pay you back. When you own a stock, you're trusting the company to generate profits. When you own gold or silver, you're trusting physics. The metal will be there tomorrow, regardless of what governments do, regardless of what companies do, regardless of what happens in the world. This is why precious metals rally during uncertainty. They are the only assets that do not depend on someone else's promise. Markets are increasingly pricing in the possibility of significant interest rate cuts from the Federal Reserve under its new leadership. This is the macro tailwind that will not quit. Lower rates support commodities by reducing the opportunity cost of holding non-yielding assets and by weakening the dollar. The market is now expecting multiple rate cuts in 2026. Every cut is fuel for the precious metals fire. Every cut weakens the dollar. Every cut makes debt easier to service, which means more debt will be issued, which means more currency debasement, which means higher prices for hard assets. This is the cycle that is now self-reinforcing. The Fed cannot raise rates because the debt is too high. The debt is too high because rates were too low for too long. And now they are trapped. They have to keep rates low. They have to keep printing. And gold and silver will keep rising as a consequence. Let us address the path to $100, because this is no longer a fantasy. It is a technical and fundamental inevitability. Market analysts are now targeting $100 per ounce as a psychological and technical milestone. The path is clear. China's export restrictions are not going away. The industrial demand from solar and AI is not slowing down. The monetary debasement is accelerating. The supply deficit is structural. At current prices, there is not enough incentive to bring new mines online. Mining projects take 7 to 10 years from discovery to production. Even if silver prices doubled tomorrow, it would take most of a decade before significant new supply hit the market. This means the deficit will persist. This means prices must rise to ration demand. This means $100 is not the ceiling, it is a waypoint. Companies in the solar and electronic sectors may be forced to announce strategic pivots such as thrifting, which means using less silver per unit or seeking alternative materials. But such transitions take years to implement. You cannot redesign a solar panel overnight. You cannot retool a semiconductor fabrication plant in a quarter. The demand is locked in for years ahead, and the supply is constrained. This mismatch can only resolve in one direction: higher prices, much higher prices. The market is now debating whether $100 happens in 2026 or 2027. That is the conversation, not whether it happens, when it happens. For the remainder of early 2026, the market will likely see a consolidation phase as traders digest the recent gains. This is healthy. This is normal. A market that goes straight up is fragile. A market that rallies, consolidates, and rallies again is building a foundation. The margin hikes will force out some weak hands. The volatility will scare some investors. But the fundamental buyers will step in on every dip. The industrial users cannot afford to wait. The central banks are accumulating. The institutional investors who missed the move from 50 to 80 are looking for entries. Any pullback to the 75 to 78 range should be viewed as a gift. It is the market giving you one more chance to position before the next leg higher. The divergence between silver and the broader equity markets is also significant. And while silver was whipsawing between 79 and 82, the S&P 500 was continuing its steady climb towards 7,000 points. This divergence highlights silver's unique position as both a safe haven asset and a critical industrial commodity. It is not correlated to stocks in the traditional sense. It moves to its own rhythm. This makes it an excellent portfolio diversifier. When stocks fall due to recession fears, silver can rise on safe haven demand. When stocks rise due to economic growth, silver can rise on industrial demand. It is one of the few assets that can win in multiple scenarios. Now let us talk about Bitcoin, because the crypto crowd is watching this precious metals rally with envy. While gold and silver have been making new highs, Bitcoin has lagged. It currently sits at the 8th position by market capitalization. Some analysts believe this lag is temporary. Owen Lau, managing director at Clear Street, argues that U.S. monetary policy in 2026 could emerge as a major catalyst for digital assets. He suggests that lower interest rates would reignite appetite among both retail and institutional investors for what he describes as digital gold. This is possible. Crypto could catch up. But I would argue that the current divergence is telling you something important. In a world of genuine crisis, investors are not reaching for digital gold. They are reaching for real gold. They are reaching for real silver, the assets that have been money for millennia, the assets that do not require electricity or internet to function, the assets that cannot be hacked or lost to a forgotten password. Crypto has its place, but in the current environment, precious metals are demonstrating their superiority as crisis hedges. So where do we go from here? The endgame is becoming clear. Gold and silver are reasserting their dominance as the ultimate stores of value. The $31 trillion market cap for gold is a statement. The market is saying that in a world of infinite fiat currency, the scarcest assets win. Silver passing Nvidia is another statement. The market is saying that the physical world matters, that you cannot build the digital future without the metals that conduct electricity and reflect light and resist corrosion. The margin hikes from the CME are an act of desperation. They are the establishment trying to maintain control of a market that is slipping away from them. They will fail. They will fail because you cannot paper over a physical shortage. You cannot margin hike your way out of a supply crisis. You cannot manipulate a market when the entire world needs the underlying commodity. Your strategy remains simple. Hold your positions. Ignore the volatility. Ignore the margin hikes. Ignore the headlines screaming bubble and unsustainable. Focus on the fundamentals. Focus on the supply deficit. Focus on the industrial demand. Focus on the monetary debasement. Focus on the geopolitical chaos. All of these factors point in one direction. Higher prices for precious metals, much higher prices. The consolidation is temporary. The bull market is permanent. The short squeeze is ongoing. The supply shock is structural. You are positioned on the right side of history. You own the assets that the world needs. You own the assets that cannot be printed or hacked or defaulted on. Do not let a 30% margin hike shake you out. Do not let a $2 pullback convince you that $80 was the top. The top is not in. The top is not even close. We are going to 100. We are going to 150. We are going to prices that will make today's levels look like the buying opportunity of a lifetime. The world has changed. Gold is the largest asset on Earth. Silver is battling for number 2. The old financial order is dying. The new financial order is being built on the foundation of hard money. And you are early. You are so early. When silver passes Nvidia permanently, when gold's market cap exceeds the GDP of major nations, when the mainstream finally capitulates and admits that precious metals are the trade of the decade, you will look back at this moment. You will look back at the margin hikes and the volatility and the fear, and you will be grateful that you held. You will be grateful that you saw through the manipulation. You will be grateful that you trusted the fundamentals over the headlines. This is not financial advice. This is a map of the territory. Make your own decisions. Do your own research. But whatever you do, do not let them shake you out at the beginning of the greatest precious metals bull market in history. The CME can hike margins. The media can scream bubble. The banks can try to cover their shorts. None of it will stop what is happening. Gold is $31 trillion. Silver passed Nvidia. The safe haven stampede has begun, and you are riding the wave. Subscribe for daily updates. Hit the notification bell. Share this video with everyone who needs to understand what is happening. The financial system is being repriced. The metals are leading the way. And we are just getting started.